All right, welcome to Talk Tickers. Today we're diving deep into CarMax's Q3 earnings call. And let me tell you, this was a big one. This wasn't your run-of-the-mill quarterly update. Nope, this was basically a declaration of a massive strategic reset. We're talking about a company that's clearly at a crossroads. So, let's break down what's happening and what it all means for the stock.
Okay, so here's how we're going to tackle this. First, we'll look at why CarMax is hitting the brakes. Then, we'll get into the nitty-gritty of the numbers. After that, we'll walk through management's new turnaround plan, figure out why the market got so spooked, and finally, I'll give you our take on what to expect next.
All right, Section 1, CarMax hits the brakes. This is really a story of beats, drops, and a big call for change. So let's set the stage here. On the surface, right, CarMax posts a beat on earnings and revenue. You think that's great news, right? But the stock, it just tanked. And that disconnect, that's where our story begins. It tells you right away that the real news wasn't in the headlines. It was in what management admitted, that the company desperately needs to change course. And I mean, listen to this. This one quote pretty much sums up the entire call. The new Interim CEO, David McCreight, said, "Recent results have been unacceptable. It is clear CarMax needs change." Wow, you almost never hear a CEO speak that bluntly. He didn't try to spin it, he didn't make excuses. He basically stood up and said, what we've been doing isn't working and things are going to be different starting now. That is a massive statement. And this right here really lays out the puzzle for us. On one hand, you've got the headlines screaming, beat. They beat EPS by 12 cents and revenue by $150 million. Normally, that's cause for celebration. But then you look at the market's reaction. The stock closes down over 4%. And look at that volume. Almost 12.5 million shares traded, more than double the average. It's clear as day. Investors heard that CEO's warning loud and clear, and they didn't hesitate to sell. So, okay, if the headlines were good, but the stock dropped, what gives? Well, to figure that out, we've got to peel back the onion and look at the numbers under the hood. This is where the real story is. So let's start with the good stuff, the numbers they were probably happy to report. GAAP earnings per share, or EPS, came in at 43 cents. The consensus on Wall Street was only 31 cents, so they beat that by a cool 12 cents. Not bad. And it's the same story with revenue. They brought in almost $5.8 billion. The street was looking for about $5.64 billion, so they cleared that hurdle by about $150 million. So you're looking at this and thinking, hey, 2 for 2, pretty solid quarter. Well, hold that thought, because this is pretty much where the good news stops. Because here's the catch, and it's a big one. Yeah, they beat expectations for this quarter, but those expectations were already pretty low. When you compare this quarter to the same one last year, it's a totally different story. Look at this. EPS was 81 cents a year ago. Now it's 43. That's nearly cut in half. And revenue? Down almost 7%. So the business is actually shrinking. They just didn't shrink quite as badly as the bears were predicting. But the real pain is in the nitty-gritty operational numbers. Comparable used unit sales, that's a super important metric for retail, they dropped a whopping 9%. Gross profit, down almost 13%. But the number that made my jaw drop is this last one. SG&A, that's basically their selling, general, and administrative costs. You know, the cost of running the business. It ate up 98.5% of their gross profit. Think about that. For every dollar of profit they made selling cars, they spent 98.5 cents just running the company. A year ago, that was 85 cents. That is absolutely, completely unsustainable. So the business is obviously in a tough spot. The big question is, what's the plan? Well, management came out with a new strategy, and it's basically a choice to take their medicine now. They're making a very deliberate and, let's be honest, a very painful trade-off. They're going to sacrifice short-term profits to try and get sales moving again and, frankly, ensure the company's long-term survival. And they didn't beat around the bush about it either. They said it flat out on the call. Our immediate pricing and marketing actions may pressure earnings in the near term. That's Wall Street speak for, hey everyone, brace yourselves. They are telling investors loud and clear that the next few earnings reports are probably going to look pretty ugly, because right now their number one priority is to stop the bleeding on sales. So what does this plan actually look like? Well, it breaks down into 3 main parts. Step 1, get more competitive on price. That means they're going to have to lower their margins to attract buyers. Step 2, spend more on marketing. They've got to invest to get people thinking about CarMax again. And step 3, try to balance all that out with some aggressive cost cutting. They're aiming to slash over $150 million in those SG&A costs by the end of fiscal 2027. It's a pretty classic turnaround strategy, but man, it's a high-stakes game. Okay, but there's another huge piece to this puzzle, and it adds a whole other layer of risk. Who's leading this charge? An interim CEO and an executive chair. The board is actively, urgently looking for a permanent leader. So you have to ask yourself, who's going to be in the driver's seat to actually see this really difficult multi-year plan through? That's a big question mark hanging over everything.
All right, let's put it all together now. We've looked at the ugly numbers under the surface, we've seen the painful turnaround plan, so now let's talk about why the market got so spooked. It's because Wall Street is a forward-looking machine. They looked right past those headline beats and saw nothing but a tough, uncertain road ahead.
So what were the big red flags for investors? Well, first, that deep 9% drop in comparable sales. That's a huge deal. Then you've got those overhead costs eating up almost all their profit. And on top of that, management told them to expect more pain in the near term as they cut prices. You throw in the uncertainty around who's even going to be CEO in 6 months, and yeah, you've got a perfect recipe for a sell-off. And just to put the investor mindset into perspective, look at this chart. This is a gut punch. Over the past year, while the S&P 500 is up almost 15%, CarMax stock has been obliterated, down over 50%. So you've got a whole lot of investors who are already deep in the red. Their patience is running out. The last thing they wanted to hear was a plan that basically says it's going to get worse before it gets better. And this really boils it all down to one key question, doesn't it? Can they pull this off? It's like they're in a race against time. They're intentionally hurting their profit margins to get sales back, while at the same time, they're scrambling to cut costs to save the bottom line. The big question is, can those cost savings kick in fast enough to stop the bleeding from the lower margins before investors just completely give up and walk away? Okay, so that brings us to our final section, the next call. What's our take on all this? Let's look into our crystal ball and talk about what we think is coming next quarter, what our official rating on the stock is, and even a potential trade idea. So here are our predictions for Q4. On the results front, we do think comps will get a little better. I mean, it's hard to get much worse than negative 9%, but they'll still be negative as those price cuts start to trickle through. As for margins, gross profit per unit, or GPU, is definitely going to drop below that $2,235 level we just saw. Management pretty much guaranteed that. And for the stock price, we think it's going to be stuck in a trading range, just bouncing around, and it'll be super sensitive to any whispers about the CEO search or changes in used car data. So, with all that in mind, we're slapping a rating of market perform on the stock. Now, what does that mean? It's basically neutral. We see the potential for this turnaround to work eventually, but we also see a ton of risk and guaranteed pain in the short term. So for us, it's not a buy, it's not a sell. We're just going to watch this one from the sidelines. And now for our trade idea, it's what's known as a paired trade, which is a neat way to play both sides of a trend. The idea is this. You'd go long on a bunch of auto parts retailers, and at the same time, you'd short CarMax stock. The thinking is pretty straightforward. If people are too squeezed to buy a new or used car, which is exactly CarMax's problem, what are they going to do? They're going to spend money to fix up the old car they already have. That's a direct win for the auto parts guys, and it acts as a really nice hedge against all the problems CarMax is facing. And of course, we always have to say it, this is not financial advice.